Most credit cards function as quietly engineered wealth-destroying traps. For over a decade, we lived through an era of easy money, where central banks kept borrowing costs near zero. But that period has ended, replaced by a high inflation reality where borrowing cash is expensive. To fight that inflation, the Federal Reserve raised short-term interest rates to cool down the economy. By raising those rates, they made every loan, mortgage, and line of credit more difficult to maintain. That pressure at the top of the financial system trickles down directly to your wallet. When it costs banks more to borrow, they pass those costs to you by hiking the annual percentage rates, the APR, on your credit cards. The financial pain many people feel today is the result of a global monetary squeeze, not a personal failure. It caught millions of households at the exact moment their living expenses were peaking. This high-cost environment is the opposite of the original intent of credit cards, which was to remove the friction from spending money. In 1959, the banking industry designed these early cards to spur working-class consumption by making every transaction as smooth as possible. Behavioral economists study a concept called the pain of paying. When you hand over physical cash, your brain registers a negative psychological response. You can feel the money leaving your hands. Credit cards bypass that friction. Swiping replaces that pain of loss with the dopamine hit of immediate gratification, while delaying the actual financial consequence for 30 days. These two forces have collided. We have been psychologically conditioned to swipe effortlessly at the exact moment the interest rate trap snapped shut. A credit card is a designed wealth extraction machine for the banking industry. This chart shows 4 credit card revenue pillars: late fees, minimum payments, rewards, and the most profitable, interest. That reward system is subsidized by the interest paid by consumers falling behind. Wealth drains directly from those in debt into the accounts of point harvesters. The most effective tool banks use to maximize that interest extraction is the minimum payment. The credit card industry relies on consumer failure. Your inability to pay your balance in full is the metric they use to measure their success. Let's look at the math. Consider a consumer named Sarah who accumulated a $10,000 balance to cover rising living costs, carrying a 25% APR. If Sarah makes only the 2% minimum payment, the payoff trajectory is almost flat, taking decades to clear. As the timeline compresses, the red area representing pure interest grows until it doubles or triples her original $10,000 debt. Beyond the cash lost, there is compounding collateral damage. That high balance completely crushes her overall credit score, which blocks her from affordable auto loans and mortgages and prevents her from investing for the future. The minimum payment steals your future wealth. It mathematically traps you in a lower economic class, paying a premium just to survive. Because this trap is built on math, it has an exploitable mathematical solution. One strategy is the debt avalanche. Attack the highest interest rate first to kill off toxic interest. Another option is the debt snowball, prioritizing the smallest balance. You pay more interest overall, but gain momentum to stay disciplined. Before you do either, you have to build a starter emergency fund and an aggressive budget. You need a cash buffer so you're never forced to swipe plastic for an unexpected expense. To break the wealth extraction machine, you must aggressively pay more than the minimum. To use a credit card safely today, you follow one rule. Pay the statement balance in full, every single month. Paying in full legally forces a 25% APR down to an effective 0%. You keep the fraud protection and the rewards points without paying the bank a dime. The Fed raised rates and banks weaponized minimum payments, but with strategic payoff plans and paying in full, you can reclaim wealth from their system. Subscribe to follow our weekly documentaries on the financial system and building wealth.